Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today is December the 16th, 2012. As I do every weekend, I like to go through and look and run a little value scan and see if I can find some value investment opportunities for long-term investors. So we're looking this weekend at Goldman Sachs Group Incorporated, ticker symbol is GS. You can see this is a 10-year monthly chart. Each one of these candlesticks represents a single month of trading activity. So this current month, being the 16th, is not finished forming there. And the main thing I wanted to show you on this chart was the book value, current recorded book value of $140 a share. Anytime price trades below book, that's where I start looking for my buy opportunities. And this is an opportunity that you may want to be considering. Okay, here we are on Yahoo Finance. You can get this information anywhere. Like I said, Yahoo Finance, Google Finance, your discount broker will have the information. It's just everywhere, so you can find it wherever you like. I'm just going to use Yahoo Finance because everybody has access to that. The main thing to point out right off the bat is looking at the summary page here. You can see the current closing, the stock price on Friday was $119.36. That is obviously below book value of $140. You also notice that you have a dividend yield of 1.7. I prefer 2%, but 1.7 is pretty darn close. Earnings per share of $10.42 per share, and you know that Benjamin Graham wouldn't even look at a company that didn't have at least a dollar per share and earnings per share. So this one would qualify there. PE ratio, anything at 15 or lower is a potential situation I might be interested in, and PE ratio at 11.46 meets that. If it were to fall to 10, of course, it'd be a stronger buy. Basically, looking at that, that's about all you can get from this page here, and let's go on to the next one. Here we are looking at the key statistics for Goldman Sachs Group, and you can see that we can look at the trailing PE ratio of 11.46 that we've already talked about. The forward PE ratio is 9.41, not as trustworthy as trailing because trailing PE ratio is basically based on information that we know. The forward PE ratio is based on projections, but their projections indicate that they're bullish on the company, believing that they're going to make more money than they did the year before, so that's good. Scroll on down, see what else we can find here. Move that back up there. Profitability is always an important element of any company you're looking at. So profit margin at 18%. It's not too bad. Operating margin is 27%. That's pretty good. Return on equity is a little bit low at 7.6%. All financial companies have been taking a hit on the return on equity simply because of all the new regulations that are going into effect. That's something you may want to look into. All right, let's move on down a little bit further. Let's see if we can get a little more information out of that. We got the tools. Okay, we can see from the basic key statistics we're looking at here on Yahoo Finance that we also have quarterly revenue growth year over year of 132%. That was an improvement over the previous. And then we can move on down. Total cash is $845 billion versus total debt of $477 billion. That's good. I want to see those scenarios. I don't like situations where I have debt that's greater than cash on hand. And I mean, if it's slightly better, I mean, if debt is slightly higher than the cash on hand, that's one thing. But if you have total debt of 10 times the cash available on hand, that can get to be a problem for a company that is basically get too much debt and we have a recession or depression or something of that nature. The company sees a hit to their earnings per share. They can't maintain their debt levels and it ends up sinking them. It's one of the things that warned us off of many of the companies that people got burned with or burned in back in the 2008 crash. So that's important to note. And again, in book value per share, most recent quarter is 140. One item to note here would be the current ratio. You'll notice that in every one of these videos I tell you that Benjamin Graham required or preferred to find companies that had a 2 or greater. This one has 1.52. Current ratio basically means the amount of cash on hand that could pay off their current liabilities in how many times they could do that. So in this particular case, they could do it 1.5 times. That's fine. They're still able to pay off all their current liabilities, but it's preferred by Benjamin Graham to have at least a 2. So you'd want them to be able to pay off their debt or their current liabilities at least twice. Let's move over here and see what we think about this information on here. How confident is management of the company? Percent held by insiders is 7% roughly. That's not too shabby. And percent held by institutions is 19%. 19.5%, 20%. That's actually might be a good thing here. Whenever you see institutions that have a stake in the company, but not a enormous one, you don't have like an 88% or something of that nature, then you could make the argument that if this company is in fact getting stronger and more profitable and is undervalued by opportunity, then in fact institutions will also see that and they'll start dumping money in to increase their position or their stake in the company, and that can actually drive the stock price that much faster, that much higher. So that's an important little piece of the puzzle. Scroll on down and see how safe that dividend is that we talked about earlier. Not massive, but it's still worth checking. You can see that the forward annual dividend yield is 1.7%, and then you move on down here to payout ratio. It's 15%. That basically means it's of the actual money that's coming in from the company's earnings, only 15% of it is being used to actually pay a dividend. So that's actually very low, and you're not going to be concerned with them having to cut that dividend. In fact, I would look for them to raise it. Okay, I'm going to go over to the cash flow statement and look at one more little detail right quick. As you guys know, this is just an overview, kind of hitting a couple of key elements to draw your attention to, maybe whet your appetite, but you're going to then go and do your own due diligence and all that. So I'm just kind of hitting a couple of items that are jumped out to me as being good signs for a company. You can see that the sale purchase of stock, it could be a positive or a negative number here. If it were a positive number on the cash flow statement, then it would be telling you that the company has been selling stock, which basically means they're trying to raise money off the sale of stock, but that would also dilute current shareholders. It would be a negative thing. In this case, you see a negative number here for the past 3 years, and this is actually showing that they're buying back their company's stock at these oversold prices. That's a good thing for current shareholders. You'll notice here that you get 2.3 billion, and here 7.9, almost 8 billion. They've actually ramped up their purchases as well. That's also good. If you've not been to the free website at perfectstockalert.com, it's right there. It's 100% free, and all we ask in return, please refer a friend. God bless, take care, and I'll see you in the next one. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.